cash reserve ratio, that is CRR. Banks are the institutions that accept deposit for the purpose of lending and investment. Whatever deposit the banks are accepting from public, it is deployed broadly in these three categories. A part of this, rather a small part of this, is maintained as cash balance or bank balances. So this is represented by this portion. Another portion that is invested in securities. Now these securities can be government securities, these securities can be corporate securities. So this is represented by this portion. But a larger portion of these deposits is given as loans and advances. So this is represented by this portion. Now here we are basically concentrating on this portion, cash and bank balances. So as I said, a part of this deposit which banks are accepting from public, it is kept in the form of cash in hand for meeting day-to-day requirement of a cash. In addition, there are legal requirements also. As per those legal requirements, a part of this deposit has to be maintained as cash balance with Reserve Bank of India to meet provisions of RBI Act 1934. Now this cash balance which is maintained with RBI is called cash reserve ratio, that is CRR. So how much is to be kept? So this rate of CRR, that is decided by Reserve Bank of India, and it is changed from to time. And this changes in the light of economic conditions including inflation situation. So rate of CRR, that is decided by Reserve Bank of India in the light of economic situations in the country and inflation situation. Now this amount is calculated by banks with reference to their net demand and time liabilities, NDTL, and major portion of these demand time liabilities is in the form of their deposits which they are accepting from public or from other sources. Now this balance with Reserve Bank of India is maintained as an average fortnightly balance. This means this balance may fluctuate on day-to-day basis. But at the same time, banks have to make sure that at any given point of time, the minimum balance must not go beyond a percentage fixed by Reserve Bank of India as percentage of average fortnightly balance. So whatever balance they maintain on daily basis, so that balance is to be maintained as average fortnightly balance. On a particular day, this balance must not go below a particular percentage. Now we can see an example here how the CRR balance is maintained. Let us assume the amount of net demand and time liabilities is 10,000 crores of a bank. Let us also assume that CRR rate is 4% fixed by Reserve Bank of India. This means this particular bank has to maintain average fortnightly cash balance of rupees 400 crore, that is 4% of 10,000. Now this minimum balance on a particular day, it must not go below that percent which is fixed by Reserve Bank of India. In our this example, we are assuming that percentage as 70%. So 400, its 70% is 280 crore. This means in this CRR balance, the minimum balance must always remain 280 crore. But fortnightly average must be 400 crore. Now if RBI is maintaining this balance, but RBI is not paying any interest to the banks. So RBI is keeping these cash balances free of interest. but banks are paying interest on the deposit which they are using for CRR purpose. In case there is default in maintaining CRR, there is a provision that bank will pay interest to Reserve Bank of India for the default period and for the default amount. Now, whenever CRR is changed, what is the impact of change in CRR? So whenever CRR changed, let us assume CRR is reduced. If CRR is reduced, the cash balance to be maintained with the Reserve Bank of India, that would decline. This decline means liquidity with banks will increase, and the corresponding amount increases the lending capacity of the banks. And when lending capacity of the banks increases, they can earn extra income interest from that lending, and that would lead to more profit. On the other hand, if CRR is increased, the cash balance to be maintained with the Reserve Bank of India, that would increase. In that case, the liquidity with banking system would decline. To that extent, the lending capacity of the banks would decline, and then decreased lending capacity will decrease their income, and that will also reduce their profits. Thank you friends for watching this video. I hope you have been benefited by the contents. In case you want to have more videos and information about banking related issues, you can log in our website or contact at the given telephone number, or you can email also. Thank you.